Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for Wealth Press. Today is Tuesday. It is the 6th of April. It's technically the second trading week of April because last week we did have the first part of April. But anyhow, it's a Tuesday. Let's talk about the markets. I want to talk about the S&P. I want to talk about the NASDAQ. I want to show you which stocks are rising, and I want to show you three hot stocks in the industrial sector that are making headways right now. But first, let's start with global economy. So Wall Street rally reflected some optimism about the economy recovery from the pandemic. Right now, the NASDAQ is down just a fraction, down about 10 points. S&P's down 6, the Dow's down about 33. But this is interesting. Second day in a row, the bond market is up while the futures are down, which means we are not in lock and key with the bond market anymore, which is really, really good. Now, looking at the QQQ in isolation mode, I kind of want to go through global economy and show you where the markets are at the same time. We are now 2 days above, so we are now back in the bullish phase in the NASDAQ, and we are again in a bullish phase on the Russell, as you could see right here. But as I showed you yesterday, momentum levels on the broad market are insane right now. If you look at the S&P 500, if you look at the indices, you will see this is insane. Look at this. 94% of stocks in the S&P are trading above the 200-day moving average. I got to show you this. I know I'm showing this to you almost every day, but this is insane. This is beyond the 20-year high. Look at this. Here, this is a max. This is going back to 2006. So let's go see if we can go a little further back. I guess 2006 is as far back as we can go. But so that's 15 years of data. But it's the highest point that we've seen here. Look at that. Highest level ever in the last 15 years. So I'm very, very cautious, and I think we're going to have a little pullback in the S&P, and that may impact the overall structure of the market, including some pullback on the NASDAQ and the Russell. But the Russell and the NASDAQ seem to be breaking out right now, which is very, very positive. Investors appear to take in stride an announcement by Swiss bank Credit Suisse on Tuesday that it expects a one-time charge of 4.4 billion Swiss francs. That's $4.7 billion related to a previously announced default of a U.S. hedge fund on margin calls. And I think you guys know exactly what I'm talking about. Credit Suisse didn't identify the hedge fund, but news reported identified the hedge fund as the New York-based Archegos Capital Management, whose default also has ensnared Japan's Nomura. Household spending data, this is not good, released on Tuesday, showed 6.6% decline in February. That's not good, and that's not going to bode well for the retail sector. That's why we have to be very, very cautious right now. This is a good reminder that we're not completely out of this mess just yet. Because again, if the spending data is down, how's that going to impact or reflect on the GDP? GDP is 70% consumer or household spending data. So that's not positive. Deep worries remain over the pandemic, with medical experts warning Japan to brace for a fourth wave of surging infections and death related to COVID, as the nation has fallen behind the rest of the world in testing and vaccinations. I'm surprised, actually, because you would think Japan is really on top of things. Similar outbreaks have flared in other countries, including India and Thailand. So we've got to be cautious with Asia right now. And energy, crude oil is dropping below $60 a barrel, where it has held for quite some time. Now, in terms of the overall stock market, I showed you momentum levels. They're really crazy right now. So if you look at the S&P 500, let me look at the S&P real quick here. We are extremely bullish on the S&P. And when I say extremely bullish, folks, I'm talking like a little over bullish. And if you look at momentum levels, you will see right here that we are seeing divergence again. Strong divergence. Look at that. Look at that. See that? It just doesn't go away, does it? Let me delete this thing. Upswing, downswing. We are higher, but we can't maintain it. Remember what I told you, till momentum levels are below diverging, till they're below break even, we're going to see an overbought market. You are continuously seeing, folks, a stretched out rubber band that goes like this and goes back, that goes like this and goes back. This market really needs to go to the 200-day moving average and and shake out, have a real shakeout. I want to see this, the number of stocks above the 200-day moving average, go to the 40th, 20th percentile. And then this divergence that you're seeing between price and the oscillators will no longer be there. Because what you're seeing is you're seeing a stretched out market, stretch out further and come back in, stretch out further and come back in. Getting overzealous here, hitting my microphone and everything. So you're seeing it not come back all the way. You're hitting it kind of like coming back to the 80th percentile, going back to 95th. Until we see that, the market is going to be stagnant and you're not going to see a big parabolic move out of the S&P. And this is going to reflect the small caps and the mid caps and the NASDAQ stocks as well, because you can't have the S&P overbought and going down to the 40th or 20th percentile of stocks trading above the 200-day moving average without impacting the NASDAQ 100. That is just not going to be possible. That's unreality or unrealistic expectations. So again, you're seeing divergence again, and you've seen it before, and you're going to continue seeing this divergence, because if you have an overbought, overstretched market, there's only so much it can go before it has to snap back. And that's what we're seeing. So we got to be very, very, very cautious, because at any given time, we can snap back, and it's going to happen sooner than later based on the momentum levels that we're seeing right now. I mean, this is nosebleed territory, folks. As I said, this is the highest level. Look at this little band above on the screen right here. Just follow this little line. You see that? It's the highest level in the last 15 years, since 2006, 2007. I mean, this is like, let's see how far back. 2006, as far back as it goes. And we have the highest momentum levels in our history, in our database history. So you got to be very, very cautious. Now, in light of that, if you look at the cumulative strength index, this is the NASDAQ 100. Chips. The FANG stocks are not leading. Applied Material, that's a chip stock. Lam Research, that's a chip stock. KLAC, that's a chip stock. Western Digital is not a chip stock, but it's a memory stock. They make the hard drives. Then you have travel stocks. Again, you have Micron, one of the largest chip companies. Again, another chip company, another chip company, another chip company. Then you have another chip company. Then you have some FANG stocks. So FANG stocks, as you could see here, usually NASDAQ 100, FANG stocks are leading. The only FANG stock that's really looking well is Alphabet. Aside from that, you've got some travel stocks. You've got a couple of retail stocks, but mostly chip stocks. Chip stocks are driving the NASDAQ 100. Now, let's look at the S&P 500, and I'll show you what's driving the S&P 500 as well, which is actually looking really good right now, because what I'm seeing in the S&P is a good broad exposure. Sherwin-Williams, remember this stock, by the way? I told you the stock was looking really good. I want to show you how it's done lately. Take a look at this stock. We've been talking about it nonstop. We started talking about it like the $28 level, $30 level. It's now the $250 level. But anyhow, if you look at most of the stocks, you will see that the S&P has a really good exposure in there, and that's what you want to see. You want to see good you want to see a little bit of everything in the S&P 500. You've got basic materials, you've got data, you've got tech, you've got energy, you've got retail, you've got energy, you've got retail, you've got energy and retail. But you've got other stocks too. You've got airline stocks coming up. You've got more retail stocks. So I'm liking how the S&P is starting to look. Although it is mostly retail and energy stocks, it is getting some basic materials, financial, in it as well. So I would say the S&P 500 is a lot broader right now, but it's grossly overbought. Now, with that said, if you look at the major sectors, and we look at this almost every day, you will see on a broad basis that industrial is the third spot. And if you look at it on a monthly basis, you will see that industrial is the third spot. But you will see that consumer staples, utilities, real estate, technology is not really cutting it too well. Basic materials is even higher. And if you look on an average basis, you will see that basic materials and industrial are right here. And you'll see energy, financial. It looks like the business sector, not the tech sector, but the business sector starting to make money. And that's why, remember Biden, his infrastructure plan, industrial, basic materials, industrial. And when you look at it on a 1 month basis, industrial right here, industrial, utilities, real estate, infrastructure, folks. What do I have for you today? 3 big infrastructure stocks. Rockwell Automation, swing high right here, all-time high actually. Oh yeah, pull back, not to the 50-day moving average, just to the 10-day EMA. And if you look at the profile of the stock, what will you see? Industrial robotics. I love this stock. Industrial company giving us 82% return over a year. That's love. Next stock, Union Pacific. Gee, what does Union Pacific do? Industrial, transports, 1 year return, 61%. It's one of America's leading transportation companies. Chart, you may ask? Look at this. Made a swing high, nice little flat breakout, nice little flat pattern. It's been going sideways for about, let's see here, for several months now, for about 4 months going sideways. Let's see, 1 year chart. Look at this. Congestion. What do I always say? Horizontal, vertical, horizontal, vertical. It's been going horizontal and it looks like it's ready to break out. And it's a transport stock. Next, Honeywell International. Again, look at this congestion. Looks like it's ready to make a swing high. Look at it on a multi-year basis. Nice little pullback, nice little swing high, moving higher, completely above the February of last year's Michigas that happened, all the nonsense. Again, it's breaking out right now. Look at the profile of this stock. What does it do? Industrial. Fortune 100 software, industrial company, aerospace, automotive products, services, control technologies. Folks, infrastructure, 1 year return, 72%. Technically, it's looking beautifully right now. And I mean beautifully. Look at this congestion making a nice swing high. I always tell you, if you pick up one thing from me, markets have 2 waves. I know there's Elliott waves and Gans and all this crap out there that I could never figure out. Markets do 2 things. They go vertically and horizontally. The longer they go vertically, the higher the odds they're going to start going horizontally. The more they go horizontally, the higher the odds they're going to go vertically. I know it's a real basic concept that it took me 27 years to figure out. I'm just playing with you. But seriously, the longer you see something moving horizontally, the better the odds that the ensuing vertical move is going to be powerful. And that's what we're seeing right now. And the longer something trends, like right here, when you see a nice vertical move, the odds are it's going to start going horizontally. So start looking at the market patterns this way. And the longer you see a stock consolidating, especially consolidating near all-time highs, the better the odds that the breakout is going to be meaningful. And if you pick up one thing from me today, pick that up. That is worth its weight in gold. Now, before I let you go, I've got something really important for you. Something really juicy. Folks, thanks to a little known market loophole. That's right, a loophole. I love loopholes. Almost anyone can grab weekly trade opportunities. Some could even be worth hundreds of dollars, maybe even thousands of dollars. I mean, there's some opportunities out here. In fact, Wall Street legend Chuck Hughes, he's already achieved a 96.3% win rate using this exact blueprint. He's been using this breakthrough formula to signal profits when the markets are up, down, even sideways. And he's ready to reveal all the details to you. Let's review. 96.3% win rate, makes money in up, down, and sideways markets. A formula to profit in all market conditions. Making hundreds, even thousands of dollars potentially over a week's period of time. Man, you've got to check this out. He's ready to reveal all the details to you. This is a breakthrough formula. Click on the link below to see Chuck's jaw-dropping profit generator in action right now. Right now. Follow the link below. Check it out right now. And make sure to like this video. Subscribe to this channel if you're watching on YouTube. Stay ahead of the market, folks, by being the first to be notified when we post new videos. And have an amazing day. And post some comments, feedbacks for me. I want to hear all about you. I haven't heard from you guys in a long time. I want to hear all the details. Have a great day and let me know how you're making money from these trades. Bye, guys.